Welcome back. So the stock market on November 17th, well, it sent some seriously mixed messages. On one hand, you had companies practically shouting their confidence from the rooftops. But on the other, there was this wave of fear that just seemed to be washing over investors. So what was really going on? Let's break it all down.
Right, so this is the central question for the day, isn't it? Was the market driven by individual companies making these big, bold moves? Or was it all about a wider market anxiety that just couldn't be shaken no matter what the good news was? Let's dig into it.
First up, let's talk about the power players. These are the companies that weren't just sitting back and riding the market waves. No, they were out there trying to make waves of their own. Okay, we're going to start with this massive number. $250 million. What is that? Who's it for? Well, this huge figure comes to us from the telehealth company Hims&Hers.
So, what's the story here? The Hims&Hers board has just given the green light to buy back $250 million of their own stock. And get this is right after they just finished a $100 million buyback. You know, this is probably one of the loudest ways a company can possibly signal to the market, hey, we think our stock is an absolute steal right now and we're putting our money where our mouth is.
But Hims&Hers wasn't the only one making a big strategic play today. Another huge household name made a very different kind of move, one that was all about changing who can own a piece of their company.
And that company was, of course, Netflix. Today was the day their 10-for-1 stock split officially happened. So here's how it works. If you went to bed last night with one share of Netflix worth about $1,500, you woke up this morning with 10 shares, each worth around $150. Now the total value of your investment, that hasn't changed at all. But the price tag on a single share, it's suddenly way, way lower. So why on earth would they do this? It's really simple. Accessibility. Let's be honest, at over $1,000 a share, it's pretty tough for your average investor to buy in. But at $150, well, all of a sudden owning a piece of Netflix feels a whole lot more possible for a lot more people. It's basically a move to democratize ownership of their stock.
Okay, so we've got strong companies making these really confident moves. You'd think that would be the whole story for the day, right? But it's not. Now we get to the really strange part of the day, where fantastic news for a company just didn't translate to good news for its stock. It's a real head-scratcher.
Let's start with Robinhood. I mean, on paper, they had a great news day. They put out their October operating data, and it showed that trading activity was up year over year across the board. Stocks, options, crypto, you name it. Plus, they're making this big strategic push into Europe. Everything sounds pretty good, right? You'd absolutely expect the stock to get a nice little pop.
But that is not what happened. Instead, the stock plunged over 8%. So what gives? Well, it looks like Robinhood was a victim of what you might call crypto contagion. When a huge player in the space like Coinbase drops almost 9%, that fear just spreads like wildfire. And it can drag down related stocks right along with it, even if their own news is actually pretty positive.
And this bizarre phenomenon, where strong fundamentals just get completely shrugged off by investors, it wasn't just a Robinhood thing. We saw this same pattern play out again and again with other companies today.
Just take a look at Duolingo. I mean, by pretty much any measure you can think of, this is a picture of a very, very healthy company. Revenue growing at almost 40%, an incredible 72% gross profit margin. Their overall financial health score is literally great. These are fantastic numbers.
And yet, with all of that great stuff going for it, the stock did this. It cratered to a new 52-week low. It's just a perfect textbook example of how, on a day like today, a company's amazing performance can be completely overshadowed by a deeply pessimistic market.
And it wasn't just Duolingo. We saw the exact same story with Doximity. That's the social network for medical professionals. They recently beat their earnings expectations. And what was their reward for that? A brand new 52-week low. It's just another clear sign of a market that's way more focused on fear than it is on facts.
Okay, so what are the external players? The big banks, the hedge funds. What are they doing in this kind of environment? Let's take a look at a few key calls and some big money moves that really shaped the day for a couple of specific stocks.
All right, on the bearish side of things, we've got Wells Fargo weighing in on CoStar Group. They held firm on their underweight rating and actually cut their price target from $70 down to $60. And the key reason, as you can see right here in this quote, is growing fear about just how intense the competition is getting in the real estate rental space.
But hey, not everyone was a bear today.
In that very same real estate sector, you had other analysts praising Compass for its resilience in what is obviously a tough market. It just goes to show you that even the experts are divided, which really mirrors the market's own tug-of-war between fear and confidence.
Now, if you want to see a real statement of confidence, look no further. The hedge fund Abdeel Capital has placed a massive bet on Affirm, the buy now, pay later company. How big are we talking? Over 21% of their entire portfolio is in this one stock. In a fearful market, that's not just a vote of confidence, that is a full-throated shout.
So, after a full day of all these conflicting signals, what's the big takeaway? And, maybe more importantly, where do we go from here? Let's try to wrap this all up and look ahead to the next big test for this market.
So, what is the big lesson from today? Really, it all boils down to a battle between two incredibly powerful forces. On one side, you have these individual companies flexing their muscles, showing their fundamental strength. And on the other, you have this huge wave of market fear that's threatening to pull everything down with it. It was a classic, old-fashioned tug-of-war between solid fundamentals and raw fear.
And that brings us to our final thought for the day. BellRing Brands is set to report their earnings today. Now, the stock just recently hit a 52-week low, just like we saw with Duolingo and Doximity. So the real question is, can they deliver results that are so strong that they actually break through this wall of worry? Or are they going to be just another victim of the market's fearful mood? It's the perfect test case for the theme of the day, and you can bet we'll be watching very closely. Thanks for joining me.